Hey there! So, you're thinking about getting into investing but feel a little hesitant? I totally get it. The idea of jumping into the stock market or figuring out what to do with your money can feel pretty intimidating. But here's the truth. Investing doesn't have to be scary. In fact, once you understand the basics and get started, you might even find it exciting. It's all about making your money work for you, and trust me, anyone can do it. So whether you've never thought about investing before or you've been a little too nervous to get started, this beginner's guide is for you. Let's break it all down and take the mystery out of investing together. By the time you finish this video, you'll feel much more confident about getting started, and you'll realize that investing isn't as complicated or intimidating as you might think. So if you're ready to take control of your financial future, let's dive in. We're going to cover 10 key steps to help you start investing with confidence, starting from the very basics all the way to the more advanced stuff. 10. Start with a strong foundation. Get financially stable. First, before we even talk about investing, there's something really important you need to do first. Get your finances in order. It might seem obvious, but a lot of people rush into investing without ensuring they're financially stable. This is a mistake. To be ready to invest, you need to focus on a few key things first. Pay off high-interest debt. If you have credit card debt or any other high-interest loans, try to pay them off before investing. The interest on those debts often outweighs the returns you could make from investments, so it's better to clear those first. Build an emergency fund. Aim for at least 3 to 6 months of living expenses saved up in a separate, easily accessible account. This way, if an unexpected expense comes up, like a car repair or medical bill, you won't have to sell your investments to cover it. Once you're financially stable and have a buffer in place, you'll be in a much better position to start investing with confidence. 9. Understand the different types of investments. There are a lot of different ways you can invest your money, and understanding the basics of each one will help you decide what works best for you. Let's look at the most common types of investments you'll hear about. Stocks. When you buy stocks, you're essentially buying a small ownership share of a company. If the company does well, the value of your stock can go up. But if the company struggles, the value can drop too. Stocks are often seen as riskier investments because their value can fluctuate, but they also offer the potential for higher returns. Bonds. Bonds are loans you give to companies or governments. In exchange, they promise to pay you back with interest. Bonds are generally less risky than stocks because the issuer has a legal obligation to pay you back. However, the returns are usually lower. Real estate. Investing in real estate means buying property to either sell later at a higher price or rent out for income. This type of investment typically requires a larger upfront commitment but can offer long-term, stable returns. Mutual funds and ETFs. These are collections of stocks, bonds, or other investments that you buy into. A mutual fund is managed by a professional who decides which stocks or bonds to buy and sell. While an ETF, exchange-traded fund, is like a mutual fund, but trades like a stock on the stock market. These are great for beginners because they offer diversification, which spreads out risk, and don't require you to pick individual stocks. Knowing the differences between these investment options will help you decide where to put your money. 8. Know your risk tolerance. When it comes to investing, one of the most important things to consider is your personal risk tolerance. How comfortable are you with the idea of losing money? This is different for everyone. Some people are okay with the potential of losing a bit of money in exchange for higher returns, while others prefer a safer approach where they won't risk too much. There's no right or wrong answer here, but knowing your own comfort level will help you choose the right investments. For example, if you're just starting out and you're more risk-averse, it might be best to stick to safer investments like bonds or a broad-based ETF. On the other hand, if you're more comfortable with risk and have time on your side, investing in stocks might be a better option for you. 7. Start small and be patient. One of the biggest mistakes new investors make is thinking they need to invest a large sum of money right away. You don't need a huge amount of money to get started. Even small amounts can make a difference over time. In fact, it's often better to start small, especially when you're learning the ropes. Start by investing an amount you're comfortable with, even if it's just $50 or $100 a month. The key is consistency. Over time, your money will grow, and you'll get more comfortable with the process. It's also important to be patient. Investing is a long-term game. It's not about making quick profits. It's about building wealth over time. So don't get discouraged if your investments don't shoot up overnight. Stick with it, and you'll see the benefits in the long run. 6. Take advantage of retirement accounts. If your goal is to build wealth over time, retirement accounts are a great place to start. Accounts like a 401k or an IRA, individual retirement account, allow you to invest your money with tax advantages. For example, if your employer offers a 401k match, take full advantage of it. That's free money. You contribute to your 401k, and your employer adds money too, which can really add up over time. Similarly, IRAs offer tax benefits that can help your money grow without being taxed as much. If you're a beginner, starting with a retirement account is a smart way to invest because you don't need to actively manage it. Plus, you're investing for the long term, which helps take some of the pressure off. 5. Learn the power of compound interest. Here's a key concept that all successful investors understand. Compound interest. Simply put, it's the idea that your money grows not only on the initial amount you invest, but also on the interest or returns that money earns. For example, let's say you invest $1,000 in a stock or bond that returns 5% a year. At the end of the first year, you'll have $1,050. The next year, you earn interest on the $1,050, not just the original $1,000. This cycle continues, and over time, you'll see your money grow faster and faster. This is the magic of compounding, and it's one of the reasons why starting to invest early is so powerful. 4. Stay consistent with your investments. One of the best ways to build wealth over time is through regular, consistent investing. The key is to invest as regularly as possible, whether that's weekly, monthly, or quarterly. You don't have to invest huge amounts. Just get in the habit of setting aside money for investing. Many people use a strategy called dollar cost averaging. This means you invest the same amount of money at regular intervals, no matter what the market is doing. Over time, this can help you buy more shares when prices are low and fewer shares when prices are high, balancing out your risk. 3. Avoid trying to time the market. A common mistake beginners make is trying to time the market. That is, trying to buy low and sell high in a way that maximizes profits. While it sounds good in theory, it's incredibly difficult to do in practice. The stock market is unpredictable, and no one can consistently predict short-term movements. Instead of trying to time the market, focus on buying quality investments that you believe will do well over the long run. The more you try to time your buys and sells, the more likely you are to make mistakes and miss out on opportunities. 2. Don't let emotions control your investments. Investing can be emotional. When the market goes up, you feel great. When it crashes, you might feel terrified. But the key to being a successful investor is to stay calm and stick to your plan. The market will have its ups and downs, but panicking and selling when things get tough is usually a bad idea. Instead, remember that investing is about the long term. If you've done your research and invested wisely, you don't need to stress out every time the market dips. Stay focused on your goals and don't let fear or greed take over. 1. Seek out good resources and advice. Finally, as a beginner, it's important to seek out reliable resources and advice. There are tons of books, blogs, and podcasts dedicated to helping new investors. You can even talk to a financial advisor if you need extra guidance. Just make sure the resources you're using are credible and backed by solid research. There's no shortage of information out there, but the key is to find the right advice that fits your personal goals and risk tolerance. And there you have it, 10 steps to help you get started on your investing journey. It might seem overwhelming at first, but remember, investing is a long-term game. You don't need to know everything right away, and you don't have to take huge risks to succeed. Start with the basics, be consistent, and stay calm. You've got this. If you found this video helpful, be sure to give it a like, share it with anyone who might benefit, and don't forget to subscribe for more content just like this. Investing isn't as scary as it seems, and with the right tools and mindset, you can build a brighter financial future. Thanks for watching, and I'll see you in the next video.